Good afternoon. I'm Maureen Berry, a partner at Fasken in Toronto and co-chair of STEP's Tax Technical Committee. Today, joining me in Toronto is MacKnight, also a STEP member who's well known and a partner at Vukelich. Robin also joins me in sharing responsibility for Tax Technical Committee mandate. Finally, the third member of our presentation today is Chris Ireland. Chris Ireland is with PPI Advisory in Vancouver, and he is my co-chair on STEP's Tax Technical Committee. As you know, STEP as an organization prides itself in delivering value to its members. This webcast, designed to both educate members on the contents of the budget in a very brief manner, also goes on to provide some additional content that we thought would be of interest to members in connection with reporting requirements and some new technical developments. Another relatively very recent initiative undertaken by STEP is the publication of the Guide to the Tax on Split Income. Members would have seen an email blast with an electronic copy pass over their inbox in the last week or so. I'm happy to say my hard copy was delivered into my actual mailbox this morning, so people should look forward to this guide. It was authored by Kevin Wark, a STEP member, with assistance from various members of the Tax Technical Committee, and we think it will be a valuable resource to members for a long time to come. With that, we'll move on to today's presentation. Firstly, we'll speak to various budget proposals, personal, business, and some miscellaneous ones. Then we're going to move on to a discussion. Robin is going to give a bit of a discussion about beneficial ownership and trust reporting. And we will finish off with Chris's presentation on section 84.1 and give us a pipeline update. Firstly, the budget proposals. First budget proposal to speak about relates to housing affordability. The government announced two changes in this regard relating to making housing more affordable for Canadians. The first is that they expanded the home buyers plan to now allow withdrawals of an amount of up to $35,000 a year, as opposed to the previous limit of $25,000. This withdrawal for a down payment does not have to be repaid, must be repaid, over a 15-year period, or will be included in income if it's not. The second change relates to expansion of who qualifies. Previously, only first-time home buyers were eligible to make this withdrawal, and the budget proposes to expand this to allow maintenance of home ownership in circumstances where there's been individuals who are experiencing a marriage breakdown or a common law relationship breakdown. Moving on to changes in respect of a different type of housing, namely multi-unit residential properties. The Tax Act currently deems a taxpayer to have disposed of and reacquired a property when the taxpayer changes the use of the property from an income-producing use to a personal use, or vice versa. Currently, where the entire property has changed use, or if an income-producing property becomes a personal principal residence, the taxpayer may make an election to have this deemed disposition that would otherwise occur not apply, resulting in a deferral of the realization of any accrued gain on the property until there's an actual future disposition. However, currently this election is not available if there is a change in use of only part of a property. Budget proposes to address that and to allow a taxpayer to elect the deemed disposition to not apply in circumstances where there has been a partial change in use of a property. And this election is proposed to be available to changes in use that are made on or after March 19th, 2019. With respect to training-related benefits under the budget, there is a new Canada training credit proposed. This credit allows certain qualifying individuals to accumulate $250 per year to a lifetime maximum of $5,000, and to use this notional account and draw on it to to obtain a refundable tax credit to partially offset the cost of training fees at colleges, universities, and eligible institutions providing occupational skills training. There are a number of requirements that have to be met in order to qualify for the accumulation of this $250 annual amount. Firstly, you must be a Canadian resident throughout the year. You must file a tax return for the year. You have to have earnings between $10,000 and not more than the highest marginal bracket, which is $147,700 and change. And you must be between ages of 25 and 64. The corresponding change that will be implemented as a result of this new credit is that this credit will reduce the amount that would otherwise qualify for the tuition tax credit under the Tax Act. With respect to kinship care providers, kinship care programs are offered in several provinces and territories, and they are intended to serve as an alternative to foster care by giving financial assistance to individuals who provide care for children on a temporary basis. Under the new proposals, individuals will be considered to be a parent of a child in their care under this program for purposes of access to the Canada Workers Benefit, and the financial assistance they do receive for providing care under the kinship care programs will not be included in their income for determining entitlement to various income-tested benefits and credits in the Act. Moving on to registered plans, there are two new types of annuities proposed in the budget. The first is an advanced life deferred annuity, which is an annuity that will allow the deferral of commencement until the end of the year the annuitant turns 85, in recognition, in part, of Canadians living longer and longer. The second is a variable payment life annuity, which is an alternative for transfers from a PRPP or a pooled registered pension plan or a defined contribution registered pension plan to transfers to an RSP or RIF as currently contemplated under the Tax Act. Registered disability savings plans have two budget-related changes to them. The first is to remove the time limitation or the period that a registered disability savings plan can remain open after the relevant beneficiary becomes ineligible for the disability tax credit. The second change is to eliminate the requirement that a medical certification be obtained that the beneficiary is likely to become eligible in the future for the disability tax credit in order for the plan to remain open. Mutual fund trusts. The budget proposes this is an anti-avoidance measure introduced into this budget. The budget proposes to include rules that are intended to prevent mutual fund trusts from allocating income or capital gains to unit holders or who are redeeming their units in the mutual fund in a manner that is considered to be either result in inappropriate deferral of tax, or to convert ordinary income to capital gains. In circumstances where the rules apply, they would deny a deduction to the mutual fund trust of the allocation or the portion of it, thereby resulting in additional tax incurred at the mutual fund trust level. The proposed allocation to redeemers methodology that's outlined in the budget is intended to match the capital gains realized by the mutual fund on its investments with the capital gains that are realized by the redeeming unit holder on the redemption of their units. There has been suggestion in connection with this proposal that there will be administrative issues caused with trying to gather the necessary information in order to comply with these proposed allocation rules. These rules also apply to taxation years of mutual fund trusts that begin on or after March 19th, 2019. There are some changes related to TIFSAs as well in the budget. The budget proposes rules that will reapportion the TIFSA tax liability for business-related income earned within a TIFSA. Currently, liability rests jointly and severally with the TIFSA and the trustee of the TIFSA. However, the budget will extend this joint and several liability to the TIFSA holder in respect of any business income earned within the TIFSA. In addition, the budget proposes to limit the liability of the trustee of the TIFSA to property that is in the TIFSA plus the amount of any distributions that are made on or after a notice of assessment asserting the liability is dated. That must be a welcome change to trustees of TIFSAs. Pensions. A few related pension changes. The first change is intended to ensure that no planned contributions with respect to a specified multi-employer pension plan are made on behalf of older members in situations when they cannot actually benefit under the plan. The second change relates to individual pension plans. And it provides that tax-deferred transfers from an employer-sponsored registered pension plan to an individual plan will be prohibited unless the employer, with respect to the individual pension plan, is the same employer that sponsored the transferring registered pension plan. The budget makes reference to there being abuse of the use of individual pension plans in certain circumstances, and these measures are designed to curb that. Any prohibited transfer under these new rules will be taxable income to the employee. On the donation front, the budget proposes to change the definition of cultural property and to remove the requirement that the property be of national importance to qualify for the enhanced tax incentives applicable to donations of cultural property. This change is a result of a recent Court of Appeal case that removed the requirement for national importance, and it is in force as of budget date. Switching now from the personal related provisions and moving on to some of the business related provisions in the budget. First one I'd like to speak to is the proposed employee stock option cap. Now, firstly, I'd like to emphasize the details of how this stock option cap is not set out in the budget. The budget indicates that they propose detailed legislative proposals later in the summer. But in general, the budget proposes to introduce a $200,000 annual cap on the issuances of employee stock options in a year for employees of large, long-established, mature firms. The cap is intended to limit the amount of options under a grant that can qualify for the preferential tax treatment under 110(1)(d). The cap is based on the fair market value of the underlying shares, and the policy rationale of having it apply to the larger, well-established businesses is an attempt to support younger and growing Canadian businesses. There are materials in the budget that indicate the government has studied the utilization of stock options over the past number of years, and that there is a belief that these options are being used as a tax-preferred method of compensating executives of larger companies. The budget does say, or implies at the very least, that to the extent the deduction is not available to the employee for the half of the stock option benefit, the corporation or the employer will be entitled to a tax deduction in that case. Now, it's unclear anecdotally, it's unclear how the mechanics will work for tracing these options. Will an employee be deemed to have exercised options on a FIFO basis? Will they be on a LIFO basis? Will there be specific identification? It'll be interesting to see what comes forth in the summer legislative proposals. Of interesting note, the budget materials indicate that this proposed cap does not apply to options that are granted before the date that these legislative proposals or details are introduced this summer. Nextly, we have a new type of tax-exempt qualified donee proposed in this budget, namely a qualified Canadian journalism organization. There are a number of requirements that have to be met in order to qualify as such a QCJO. But if you do, you will get a refundable labor tax credit on salary and wages paid to newsroom employees, and subscribers to news feeds from these QCJOs will be entitled to a temporary non-refundable tax credit to a maximum amount of $75 a year for so subscribing. There was a large focus in the budget on zero-emission vehicles. The budget proposes to allow for a purchase incentive of up to $5,000 for the purchase of a zero-emission vehicle with a suggested retail price of less than $45,000, and also to allow a full tax write-off for businesses' adoption of zero-emission vehicles in the year they are put into use, to a maximum cost of $55,000 per vehicle. The budget also proposes to introduce additional rules designed to curb character conversion transactions. And in this regard, it has proposed amendments for certain derivative transactions that effectively convert what would otherwise be ordinary income into capital gains. There is a definition of a derivative forward agreement that's expanded, and there's an expansion of associated rules to ensure that these types of transactions are actually required to be reported as ordinary income. On the GST and HST front, there are a few changes. Assisted reproduction devices have now been added to the list of zero-rated taxable supplies. Previously, only property that related to the supply of human sperm fell under this category, and now it's been expanded to products aiding the supply of an ovum or in vitro embryos. Foot care devices that are now acquired pursuant to the written order of a podiatrist or chiropodist are also zero-rated. Previously, the order needed to be made by a physician, a physiotherapist, an occupational therapist, or a registered nurse. Bundled medical services now have a different treatment under the GST, HST rules. Previously, if medical services were bundled, they were not exempt, even if they would have been exempt had they been supplied on an individual basis. The budget proposes to allow for bundled medical services to now qualify for the exemption, so long as all or substantially all of the consideration paid for the service is reasonably attributable to two or more services that would have qualified for the exemption had they been supplied separately. There are changes proposed in the budget related to the refundable scientific research and experimental development tax credit, and also changes related to corporate tax income that relates to Canadian private corporations engaged in a farming or fishing business, designed to allow them to claim a small business deduction on income that relates to sales to any arm's length purchaser. Requirements for information. Currently, the the CRA may issue a requirement for information to require someone to provide information or documents for the purposes of administration of and enforcement of the various tax acts. Banks and credit unions are often sent these requirements in respect of third-party financial information, and these requirements are generally must be sent by registered mail, certified mail, or delivered personally. The budget now says that CRA can send requirements for information electronically to banks and credit unions, provided that the institution notifies CRA that it consents to this method of service. Clearly an attempt to streamline the process for collection of information. Miscellaneous points of interest. You can see from this slide what was a focus in the budget. There was a large investment in the CRA to further combat tax evasion and tax avoidance. Emphasis on cryptocurrency transactions and the perceived difficulty with which audits of such types of transactions will encounter. There's an investment to improve CRA's information technology systems and an investment in hiring additional staff to process adjustments to T1 returns post-filing and to sustain dedicated telephone service lines for tax service providers. Budget proposes increased investments in various anti-money laundering programs. And the final change that I'm going to speak to related to the budget is to make further amendments to the Canada Business Corporations Act to make beneficial ownership information more readily available to tax authorities and law enforcement. And on that note, the budget part of the presentation is over, and I will pass the presentation now over to you, Robin.
Thanks, Maureen. And I'd also like to thank PPI and Fasken for providing our undisclosed broadcast facilities today and for their general support in making this novel and hopefully long-lasting technology work. So I would like to talk about the beneficial ownership and trust reporting because there is a lot of talk about this and a lot of smoke, but not much flame. So first of all, we have to look at where have we come from? Why are we worried about this? What has prompted this concept of registers of ownership? And it's not a Canadian issue. It didn't start in Canada. It's not going to be solved in Canada. It started in the EU, which many people will find interesting because it started with a desire for transparency, which is an interesting concept that nobody can define. It just seems to be that we want more information, not that we want information that we can deal with. There is an interesting conflict with the concept of privacy, and that battle continues to rage and I think is going to continue throughout the foreseeable future because that's where our defenses are going to arise. There is a third term that automatically should be picked up called secrecy. So we have the concept of transparency, privacy, and secrecy. Again, it's sort of like the old concept of pornography. I don't know what it is, but I can tell it when I see it. Nobody can define what secrecy is other than the fact that they can't get the information that they think they are entitled to. Privacy is, I know that information belongs to you, but I think I should have access to it as well. And transparency, we're not sure. Interestingly, the original EU proposals were originally limited to anti-money laundering and combating terrorist financing. I say it's interesting that they were originally limited this way because recently, as a result of the Panama Papers and some other notable leaks lately, there have been a number of special interest groups pushing to expand the trust reporting and corporate reporting to include tax evasion. Now, everybody in the room knows that tax evasion is the national pastime of many jurisdictions in other parts of the world, including parts of the EU, and it is not surprising that it was originally not included. It's going to be very interesting to see whether the special interest groups who are really pushing the envelope on what is secrecy are going to be fought back over what constitutes privacy and individuals' and corporations' right to privacy. Now, there have been a number of directives from the EU. The first one in 2015 was their fourth anti-money laundering directive that required member states to create a register of beneficial ownership for corporations and trusts. And this was supposed to come into force in July of 2017. Not surprisingly, it is not generally or consistently in force. Many member states have not fully adopted this concept for a variety of different reasons, but mainly relating to transparency versus privacy. And the good news for us as advisors to wealthy clients is that privacy seems to be winning, but we are going to have to be diligent to ensure that privacy remains paramount. There is one notable outlier. England has created a register called the Significant Control Register. This is a novel English initiative. It's unconnected with the anti-money laundering directives and their implementation, and it remains to be seen how that is going to play out. Now, interestingly, STEP worldwide has been very active in the battle against intrusion into private affairs, and they have been very active since this concept started in the EU. They've had a number of successes and, unfortunately, a number of, I can't call them failures, but lack of success in other areas. The battle rages in England, and hopefully it will come to Canada, and we will be able to continue the good fight here and ensure that privacy remains prevalent. So how did we get here? Under the fourth anti-money laundering directive, access to a register of companies would be granted to any person or organization who demonstrated a, quote, legitimate interest, which immediately begs the question of what is legitimate versus illegitimate. Access to trust registers were limited further to competent authorities, financial intermediaries, and members of regulated professions performing customer due diligence. So, for instance, if you go to a bank and try to open a bank account, you will be, especially if you're dealing with a non-resident bank, or if you are a non-resident of Canada dealing with a Canadian bank, you will be presented with a long list of questions for the Know Your Client obligations of the financial intermediaries. That is the tangible result of this concept of trust reporting. Originally, the proposals applied to something called an express trust, an interesting concept. That's not one that we generally think of, but an express trust is one that a settlor intended to create. I'm not sure how a settlor could intend not to create a trust and have it as a trust, but we'll leave that for another day. And it had to be a trust governed under the laws of a member state. Now, if you look at that, obviously the proposals are going to be very limited, because if it had to be governed by the laws of a member state, it wouldn't catch a trust set up under the laws of Ontario, for instance, because we're not part of the EU, nor would it pick up the Caribbean islands or various other tax shelters. So this concept was expanded in the fifth anti-money laundering directive. Now, the real interesting question is who has a legitimate interest in the fight against money laundering and terrorist financing. One suggestion that certain commentators have raised is that the applicant for access to information needs to demonstrate what particular advantage to the fight against money laundering or terrorist financing could be obtained by disclosing the information. And that's a pretty high threshold. That's more than just walking in and say, I want access to the register. they have to come up with a compelling reason why their access should be granted and why access is going to promote the reduction in money laundering and terrorist financing. If this is the proper interpretation, which is a very large if, that may represent the necessary balance between transparency and privacy that we need to fight over. It's going to be interesting to see how governments react to that argument. It has not yet come to court, but it clearly is going to, especially in Canada. So where are these proposals going? Well, 2017 came and went, and the fourth anti-money laundering directive with it, replaced by the fifth anti-money laundering directive to come into force in early 2020. There is a significant expansion of the rights of access under this proposal. First of all, the proposal for companies is that any member of the general public may demand access. Now, it's not clear whether any person in the general public needs to have a legitimate interest or whether they can just show up at the company's branch and say, I demand access. I'm not sure how they get access or what kind of access will be provided, but that's one of the many uncertainties that we have to resolve. Three significant changes were proposed for trusts. First of all, it's no longer an express trust governed by the laws of a member state. It's an express trust administered in a member state, which is shades of Garon. So that is not a surprising change. It probably makes things a little clearer. The concept of trust is expanded to include civil law arrangements. Again, that's a logical extension that shouldn't surprise anyone. The third one is puzzling. Trust registers are now accessible by persons with a legitimate interest. Originally, the trust registers were only to be accessible by government agencies like FinTrack or the CRA, or certain, but not all, law enforcement agencies. Now we've got a proposal that anyone with a legitimate interest could have access. Now the question arises for entities like the Tax Justice Network and the special interest groups. They will demand access to trust registers more because they want a fishing expedition and find out what's there. And how are they going to demonstrate the legitimate interest? If we go back and say that you're only allowed access if you can demonstrate that by getting access you will lead the battle against money laundering or prove that money laundering has occurred or is about to occur, then maybe disclosure is warranted. But this is going to be something that we are going to have to be diligent in prescribing. We're going to have to take steps to ensure that we keep this as narrow as possible. Now, these events are all happening in Europe. There are some problems over in Europe as well. There are certain storm clouds. The fifth money laundering directive is in direct conflict with another directive, the General Data Protection Regulation, which came into force last May. The GDR is what I would consider a citizen's right type declaration, imposing obligations on any person to protect sensitive data of the data subjects. That imposes an obligation to keep things private and confidential, which seems to be in direct conflict with the requirement to disclose to people with legitimate interests. And if you look at the EU Charter of Fundamental Rights, Articles 7 and 8 relate to personal data and provide that everyone has the right of protection of personal data concerning him or her. So how do you take that fundamental right and allow somebody who has no interest in your affairs to go digging into your affairs because they think there might be something interesting there? There is another issue in Europe as well, the principle of proportionality, which says that limitations to fundamental rights can only be made if they are necessary and genuinely meet the objectives of general interest. Well, I guess one can say that reducing money laundering and shutting down terrorist financing are objectives of general interest, but to say that disclosure of information broadly is necessary to meet those objectives may be a stretch, and I would expect that there will be litigation over how that phrase is going to be interpreted. Note that in Canada we have similar concepts. They're not expressly distinguishable, but here the rights that are guaranteed are set out subject to such reasonable limits prescribed by law as can be demonstrably justified in a free and democratic society. And do we have issues with money laundering that allow us to create limits on disclosure or prescribe disclosure? Can we show that those are demonstrably justified in a free and democratic society? And I guess the question I've got is, who has the obligation of demonstrating that these limits are demonstrably justified? Is it in the hands of the person who is trying to prevent disclosure of information? Or is it a hurdle that somebody seeking disclosure of information must first overcome before they can apply to a court or some other authority to get access to that information? So looking in Canada, our primary legislation goes by the easily phrased Proceeds of Crime, Money Laundering and Terrorist Financing Act. Just rolls off the tongue. Thankfully, the regulations are just called the regulations. It makes them a lot easier. In February of 2018, the Department of Finance issued a consultation paper as part of its 5-year review of the Proceeds of Crime legislation. The Standing Committee on Finance in the Commons issued a report called Confronting Money Laundering and Terrorist Financing, Moving Canada Forward. It had a number of recommendations. The one that is significant and seems to be behind some of the budget proposals is a recommendation that the federal and provincial governments should create a pan-Canadian beneficial ownership registry for all legal persons and entities, including trusts, for individuals holding at least 25% of the voting rights or ownership interests. Now, all we need to think of is the long gun registry and a variety of other pan-Canadian interests to see what the chances of this happening are. Where are the provincial governments now? Most of them seem to be fighting the federal government over some issue or another. So one wonders whether this will ever come about. One of the other big issues, of course, is who has the constitutional authority to create this pan-Canadian beneficial ownership registry, since the federal limits will be narrow, the provincial limits quite broad, and one can already anticipate the kinds of arguments that the provinces are going to make that the feds should not be able to get access to these registries and there should be other controls on it. Again, the registry is supposed to be accessible only by law enforcement agencies such as FinTrack, which is the financial reporting agency, and the CRA, but not the public. So it remains to be seen. We get recommendations that seem to suck and blow, wanting access completely, but also recognizing that it could be overly broad. So how has it started? Well, it started last year with amendments to the CBCA, which will become effective this June. And what these amendments do is provide direction to corporations as to the type of information they should record and maintain in respect of beneficial owners. Now, many of you will have encountered minute books that are incomplete. We call that as a gracious nod to the fact that they have not been maintained adequately over many years. But there is no requirement under corporate law to maintain anything other than the name and number of shares that somebody owns. Now we are going to have a detailed list of information that has to be provided. The regulations to the Proceeds of Crime Act mandate regulated entities to collect beneficial ownership information, which is why when you go into a bank to open up a bank account, you have to go through the Know Your Client rigmarole. And they also mandate the financial entities to take reasonable measures to confirm the accuracy of the information. Nobody really knows what that means, but there is some new language in the amendments to the CBCA that gives us a hint that the requirements are going to be much more intrusive than we ever dared fear. The good news is that the new rules don't apply to a shareholder which is a reporting issuer, or whose shares are listed on a designated stock exchange, or who is a member of a prescribed class. Now, we don't have any regulations as yet, and it's unlikely that we will have them in the foreseeable future to find out what a prescribed class is. So really, disclosure only applies to private corporations. But big question, what happens if you've got a chain of private corporations which ultimately end up being subsidiaries of an international public corporation? Do they have to disclose? Or can you just look to the entity at the top of the corporate chain and say the top company is a public corporation, therefore disclosure is not required all the way down the chain? What happens if there is a substantial shareholder, a individual with significant control, which is the new concept, in one of those intermediate corporations? How do we deal with that? So an individual with significant control is an individual who is the registered or beneficial owner of shares, who has direct or indirect control or direction over them, which one would think would be a beneficial owner, but an individual who has direct or indirect influence that, if exercised, would result in control in fact of the corporation. Now, this is a puzzling question. There is a recent case a couple of years ago called McGilvery, a case out of Winnipeg, that dealt with association and direct or indirect influence that, if exercised, the feds did not like the result of the Court of Appeal decision, and so they changed the law and now gave us a list of things that could reflect indirect influence that, if exercised, could result in control in fact of the corporation. One wonders whether there will be a reference to that. That's 256 5.11 in the Income Tax Act. An individual to which prescribed conditions apply, and again, we don't have any regulations, so we can't say much about that. And the significant number of shares is more than 25% of voting rights, or more than 25% of all outstanding shares measured by fair market value. So that is a relatively standard test. But again, noticeably absent in the significant control are guidelines for holding companies and how far up the corporate chain you have to go before you satisfy yourself that there is no individual with significant control. So looking at what you have to now contain in your shareholders register, you need the name, date of birth, and last known address of each individual with significant control, the jurisdiction of residence for tax purposes of each such individual, the day on which they became or ceased to be one, a description of how they hold that indirect control, including a description of their interests and rights regarding shares of the corporation, other prescribed information which has yet to be announced. Interesting here, steps the corporation has taken at least once during each financial year to ensure that it has complied with these new rules on individuals with significant control. The corporation must update their files within 15 days of becoming aware of new information. It will be interesting to see what people are going to put in their minute books, because bear in mind that minute books are private. They're not public documents. They're not accessible to the public. Under the various corporate statutes, they're accessible by shareholders under certain conditions upon application. But one could reasonably ask, why do I have to clutter up my minute book with the steps I've taken to determine what the information is? And this last point is the most problematic. A corporation may request information from shareholders who must reply to the best of their knowledge as accurately and completely as soon as feasible, which is an interesting question. Sounds to me like something we've been through before, thinking back to the introduction of the offshore trust legislation and the multi-year battle we had over that, before it was finally abandoned. Are we coming back to that kind of argument here? I've got another comment. One of the requirements is completely nonsensical. Now, access to the shareholder register, one might be wary of this. It starts out with the premise that any shareholder or creditor or their personal representatives, which presumably would be their lawyers or accountants, may apply to a corporation for access to a shareholder register. Okay, nothing unusual there. Any shareholder already has that right under prevailing corporations legislation. Creditors, not so much. So this could be a new inroad for third parties who may or may not be interested in the affairs of the business. The information obtained under this right shall not be used by any person except in connection with one of three possibilities: an effort to influence the votes of shareholders of the corporation. So if you, for instance, wanted to ensure that the corporation that was a holding company did not invest in any corporations who made tobacco or firearms, you could ask for access to the shareholder register in order to put a proposal forward at the annual meeting limiting the investment opportunities of the corporation. That's a valid request. If you're going to make an offer to acquire securities of the corporation, that would also be a valid request. Now, it's not clear whether this is a public tender offer or whether if you were a private investor, you would be able to ask for the shareholders register to find out who your new shareholders are going to be, but I'm sure we can find a way to deal with that in the normal course of business. And then we get the any other matter relating to the affairs of the corporation. And who knows what that might be. Promises to be a very interesting battle. For instance, if somebody asks one of the significant special interest groups, asks a board of directors for a copy or access to their shareholders record and does not come up with a particular reason, they're not interested in influencing votes, they're not interested in subscribing for shares, and the board of directors or the person to whom the request is made says, no, we don't think that your request falls within one of the conditions under section 21.3, and so we are not going to release that information. What happens? Who does what? The corporation I write in and say, I'd like your shareholders register. The corporation writes back and says, no, we think you have an improper purpose. Then what happens? Obviously, there's going to be a debate about that, but where is that debate going to take place? Can the special interest group take me to court if I'm the board of directors? On what basis? Can they demand that, can they go to a third party and demand that the third party exercise influence over my decisions? Not entirely clear. So it's going to be very interesting to see what happens. One can bet that this issue is going to occur fairly quickly. Now, if you contravene the use of the information, you pay a fine not exceeding $5,000 or 6 months imprisonment. I'm not sure how you would imprison a special interest group, so that's really not a meaningful penalty, and certainly a $5,000 penalty for some of these special interest groups would not be significant.
Can I interject, Robert?
Absolutely.
So you've talked about special interest groups and how they may be motivated to try and use this legislation to get access to information. What about the concerns this will bring to bear for very high net worth families who go to great pains to keep their affairs and the ownership of their structures very, very private? There are, we know media loves to get details about high net worth or ultra high net worth families. Do you think they will be able to try and backdoor their way to getting access to information under that third prong?
Well, I hope not. But there's going to be a lot of battles before we get to a conclusion on that. Because if I'm, Mr. Smith, and I have far more dollars than I'm ever likely to see, and I have a relatively complicated but not unusual corporate structure to keep my affairs private and keep my family affairs private. If a special interest group comes along and they say, okay, we see there's this numbered Ontario company, I'm going to go to the company's branch and find out who the directors are. And they may or may not find Mr. Smith as a director. And they say, okay, Mr. Smith is a director of this corporation. He must have an interest in it. Let's do some digging and find out what their interest is. Well, that's a fishing expedition. And I would challenge that on the basis that that's not an appropriate use of the information. That doesn't fit within 21.3. And I would say, no, I'm not going to give you that information. And if you don't agree with me, do something.
Right, but doesn't that harken back to your earlier point where you said, where is this going to get arbitrated?
Yes.
And it could very well end up being arbitrated in public.
Oh, with no question it'll be in public. Sooner or later it's going to get public. But does it go to the director of corporations? No, there's nothing in these amendments that suggests that any dispute gets referred to the director of company's branch. Do we want company's branch acting as an arbiter of shareholder disputes in any event? They're just people who are administering the statute, making sure that we get documents in on a timely basis. I don't think they're the appropriate organization. Can we go to some other branch of government? Why? Why would a branch of government step in for a dispute that is clearly between two other taxpayers? And so clearly it's going to come up. Somebody is going to ask for information and they are going to be refused politely or maybe not so politely. And that will probably lead to some kind of litigation. It promises to be an interesting time for young litigators as they try to come up with these new causes of action. So what's next for corporations? Well, in December of 2017, the federal and provincial ministers of finance agreed to pursue amendments to their various corporation statutes to create this pan-Canadian register. So far, only the feds have done it, and they haven't taken any step to create a register. All they've said is that corporations, you must include this following information in your shareholder register. But there has been nothing to suggest that there is a separate, accessible register to which information must be provided. That step hasn't occurred as yet. And it will be interesting to see whether it will happen in the current cycle. I can't imagine anything happening before the next federal election. There are too many other issues that have to be addressed before we deal with things such as money laundering. And it depends on which province is going to be most concerned about these issues. I'm sure that some provinces, such as, for instance, British Columbia, are already taking active steps to fight money laundering and apparently being moderately successful, but other jurisdictions may not be. So where are the provinces now? They all have their own political issues as well. It doesn't seem like changes to corporate law is high on anybody's legislative agenda. So how do we deal with trusts? Effective in 2021, express trusts will be required to report the identity of all trustees, beneficiaries, and settlors of the trust, as well as the identity of each person who exerts control, which presumably means protectors. Now, again, express trust is not a concept known to law, but it means, presumably, according to some of the commentary in the legislative documents, a trust that was clearly set up by a settlor with the intention to create a trust. So that's not going to be a tough issue. But the type of information that is being requested sure looks like the information we fought over in Section 94.1 all those years ago. Under the new rules, every trust will be required to file a tax and information return unless it falls with one of the categories of an, quote, exception trust. And there's no benefit to being an exception trust because those trusts are subject to a variety of special rules in any event. Those would include things like DPSPs and RRSPs and special purpose trusts. And there are dramatically enhanced penalties that apply for failure to file returns or to make or participate in false statements or omissions. Now, I'm not so much worried about the false statements. It's the omissions, which, I don't know the information, how can I file a return? Or the failure to file a return because somebody thinks this is just silly, unnecessarily intrusive. So we now have a Regulation 204.2 that lists additional reporting requirements for trusts, predictable information, name, address, date of birth, jurisdiction of residence, tax ID number, for anyone who is a trustee, beneficiary, or settlor of the trust. That is predictable. And then we get into a bit of Never Never Land, anyone who has the ability through the terms of the trust or a related document to exert influence over the trustee decisions. So that's clearly a protector. And many trustees, especially of family trusts, are going to have to try to figure out what all these concepts are, and the compliance cost is going to be outrageous.
Can I harken back?
Yes.
To the requirement that you thought at first instance was fairly simple, or the criteria, namely, provide the identity of the settlor, the trustee, and the beneficiaries.
Yep.
Well, I'm not sure that's so simple because it has become the custom in a lot of trusts to provide for a lot of flexibility for future planning by describing beneficiaries by reference to the criteria they meet. And you see things like any corporation, the shares of which are owned by any family member, or the shares of which are owned by a named beneficiary under the trust. And so you can imagine in complex structures, you can be having multiple beneficiaries, the same beneficiary reported for with respect to multiple trusts, and also inadvertently avoiding beneficiaries being reported who conceivably are beneficiaries under the trust based on the wording of the trust document itself. So do you think this reporting requirement is going to make the pendulum swing back to narrowing the class of beneficiaries under a trust?
Let me answer the first part. The information, there is a statutory answer to part of your question. And many years ago, you may remember at one of the national conferences, we had a mock trial. And one of the arguments about the legislation was that it was invalid and ineffective because it wasn't written in either official language. And Chief Justice Bowman actually made some sympathetic remarks about that. Well, we've got it again here. because we have a requirement to provide information in the second bullet here for beneficiaries not known or ascertainable with reasonable effort. So exercising reasonable effort if you can't ascertain whether someone is a beneficiary. The person making the return must provide sufficiently detailed information to determine with certainty whether any particular person is a beneficiary of the trust. Now, it strikes me that the first part of that phrase contradicts the second. How are you possibly going to deal with that? So we've got a statutory response that's nonsensical and incapable of compliance. Going back to your broader policy question, our technology in drafting generally family trusts, discretionary family trusts, has broadened over the last 15, 20 years to give us a whole lot more flexibility. Are we going to start dialing back on some of that flexibility and say, okay, clients, let's get serious. Let's not have too much flexibility. Let's have some certainty. I think that may happen. We may say it's too difficult to comply and it's too intrusive to give too much information. So am I really likely to give anything to the great-granddaughter of great-nephew Ralph? Or am I really likely to give an amount to a corporation controlled by great-aunt Bertha, who's living in a senior's home? So we have a lot of things that we put in there because somebody may have a lot of funds and one never knows which family member may have health issues or mental health issues or may require assistance in the future. And so there are legitimate reasons for providing great flexibility in who can be beneficiaries. But I think we're now going to have to counter that with some kind of reasonableness test about, is it likely or not? Do we really need to deal with all these contingencies? Or at some point do we say, I've gone as far as I reasonably could, I'm going to stop here?
So even a more simple example. So my sibling, assume I have a family trust and my sibling is a named beneficiary under my trust, which is not that far-fetched that my sibling might benefit. I also have a class of beneficiaries that say any corporation, the shares of which are owned by any named beneficiary under my trust. Does that mean my sibling's incorporated business is now a beneficiary under my trust that has to be reported? I can certainly ascertain, I know.
You can certainly ascertain, and you certainly can provide detailed information to determine with certainty, whether your sibling continues to own those shares. So presumably that kind of information would have to be provided.
On an annual basis.
That's right, because we have to file these returns annually with the T3 return. It's going to be
an interesting world.
It's going to be a very interesting world. And there's unlike the requirement for disclosure of a shareholder record, there's no argument not to provide. The statute says, thou shalt give this information. It's not like I have to apply to somebody to get this information. You have to provide it. So something that we're going to have to deal with. Again, we had this fight 15 years ago, and we're back. There's some other funny little quirks in these rules on trust reporting. Two of the accepted trusts are short-term trusts, and those are defined to be those that have been in existence for less than 3 months at the end of the year. And for the life of me, why? Why should, if you're a young trust, why do you get exempted? And then the small value trust, and this one is just a practical problem. A small value trust has a fair market value of assets less than $50,000 throughout the year. And it's the throughout the year that's going to cause a problem, because there will be a lot of trusts, for instance, a Henson Trust, that in a rising market may have assets that exceed 50,000. It may only be for a portion of the year, so they'd be out because it wasn't throughout the year. But basing an accepted trust on fair market value of assets just seems to be wrong. It should be based on cost base. Everything else we've got, our foreign reporting rules are based on cost base of assets rather than fair market value. And who knows at the end of the year what the fair market value of an asset is. The bigger problem, though, is that there is no exemption for trusts that hold illiquid personal use assets or non-income producing assets. So if you had a trust that held your family cottage, or that was an insurance trust for purposes of your estate planning, you would have a trust that you would have to report. And who's going to pay the cost of this reporting? And what's the point? What information is gained by reporting this to somebody in Ottawa who will probably put the report in a box in a warehouse in suburban Ottawa somewhere, and then maybe assess penalties if they ultimately find out that there was non-compliance? And here we go back to the European concept of proportionality. We're going to have penalties that are disproportionate to the offense, and we're going to have information that is really not relevant. So there should be more exceptions to cover off non-income producing personal use assets.
You might have thought that if you had to disclose the beneficiaries once, then once you've disclosed once, if there's no income earned in future years, you're waived, maybe?
Well, that's another interesting point. What happens if you have several family trusts for different members of the family or for different purposes? So for instance, you had a general family trust, and then you had a spendthrift trust for a particular sibling, and you had a Henson trust for another sibling, and you had another education trust for a distant relative. Do you have to disclose all of those, or can you somehow find a way to say, well, these are all family, within the family unit, we can have some kind of unit filing? Some issues that have not yet been addressed. From the corporate side, we've had this before, and this argument doesn't seem to get much traction, but we have to go through a lot of effort to get information of questionable value. What will really happen if there is non-compliance? What happens if a board of directors forgets one year to send out the information request? Who is going to police the system? Do we want the administrators of the CBCA to become policemen? Do we want any third party to have any right to enforce the CBCA? That would seem rather odd. I can't think of any other situation where a third party has the right to enforce obligations under a statute, particularly when there are no corresponding benefits to obvious users or people relying on the statute. What happens if a corporation reasonably determines that the person seeking the information has an ulterior purpose? Well, presumably we're going to have some interesting litigation on that. And going back to one of my first points, the EU proposals were based upon a concern about money laundering, and that the demand for information and the disclosure had to show that the fight against money laundering or terrorist financing would be furthered by disclosure of particular information. Will that argument be accepted in Canada? More to the point, where will that argument be advanced in Canada? Presumably it'll tie in with the bullet ahead of it, and sooner or later we'll get an answer to that, probably far later. In trusts, the registers will become part of the trust returns. So does that mean that Section 241 applies and that the disclosure will be limited or protected by the Income Tax Act? Interesting question. One would hope the answer is yes, but can you then rely on Section 241 to prevent disclosure to special interest groups. The real problem I've got, though, is that CRA has certain obligations under treaties and TIAs to share information, and under those TIAs, sometimes they have to automatically forward information that is sent to them. So if I send information concerning my family trusts and CRA receives it, does it, for instance, automatically have to send that to the well-known tax authorities of Zambia, which is one of our TIA partners? I might not be terribly upset if it was shared with the IRS, particularly if I had a Florida condo or I had assets in the US. But I would be very particularly concerned if it ended up in the hands of some other jurisdiction to which I have no connection, but who has an obligation to get this information from CRA. So somehow we're going to have to tighten up CRA's obligation to divulge this information. And there is a concept called a politically exposed person, which would be, for instance, your wealthy doctor in Brazil who has, assets outside Brazil and a high income and many children that he does not want to have kidnapped, which is an issue that is very real in certain parts of the world. Thankfully not yet in Canada. But how does Canada protect that kind of person? So, takes me to the end. I had a great picture here of Yogi Berra, but is this deja vu all over again? The corporate and trust proposals seem to be a reaction to the EU initiatives, but without considering whether the bases for those initiatives are appropriate for Canada. We have two notable outliers on these proposals. England is the outlier on corporate disclosure, and it has imposed its own regime. The USA is the other notable outlier because it doesn't seem to be part of any regime. Should we wait to see how or if it reacts, or should we just let it go its own way? There are just too many uncertainties to be resolved before we can implement any meaningful form of shareholder or trust register. And my question is, will all this just be a tempest in a teapot? Probably not. There will be special interest groups out there who will say that their teapot includes everybody. But my bigger question is, there are so many unanswered questions, and there are so many half-baked proposals in these proposals. Are we going back to the summer of 2017? Been there, done that.
Don't want to do it again.
Don't want to do it again. And with that, we'll pass it out to the sunny West Coast.
Thanks, Robin. As Robin and Maureen have mentioned, I will now wrap up our webcast by looking at two areas, Section 84.1 and doing an update for you on pipeline planning. 84.1 is an area where it is often litigated, in fact one of the most frequently litigated sections in the Income Tax Act from the perspective of the client suing the advisor. In other words, advisors often forget about it and forget about its impact. In fact, there's a recent BC Supreme Court case, Crean, C-R-E-A-N versus Canada, where a rectification was used to revise the structures that 84.1 did not apply. Not that we want to rely on rectification, but it's just another example of an advisor forgetting about the implications of 84.1. Let's look at that now from a budget perspective, in the sense of this wasn't addressed in the budget. And the issue that we want to explore in more detail for the next few slides is that when you look at 84.1, it's a potential impediment to intra-family succession planning. It's often a better result if you can sell your shares to an unrelated party than selling to a family member. Finance is aware of this issue. They've received a number of submissions, and there was hope that we're going to see some relief in this budget. We have not. Although finance did acknowledge the issue, and I've got on this slide an excerpt from the budget document. Let me just read from that, where they state, the government will continue its outreach to farmers, fishers, and other business owners throughout 2019 to develop new proposals to better accommodate intergenerational transfers of businesses while protecting the integrity and fairness of the tax system. But we don't have anything yet. Let's therefore look at what is the problem. Why is this an issue with respect to transfers between family members, potentially, and not an issue when you're transferring or selling outside the business? 84.1 is, in its essence, an anti-avoidance provision. It's really meant to prevent someone from stripping surplus or taking surplus from a private company based on using the capital gains exemption, or perhaps for older companies using V-Day value. However, when you look at the detail of 84.1, it goes much beyond that. It can in fact apply to any non-arm's length sale of shares of a corporation to a non-arm's length other corporation. And that really is the problem. When you look at 84.1, it has its own definition of cost base, and what tax advisors often refer to as hard versus soft cost base. If you have hard cost base, that's good. Soft cost base is not good. An example, if I sell shares, say, of a family business to my daughter, I use the capital gains exemption. That stepped up cost base to my daughter is soft cost base, not good cost base for purposes of 84.1. And now to get into the issue in a little more detail, in terms of why it can be better to sell outside the family, when you look at the result and the detail of 84.1. 84.1 can apply where someone, an individual or a trust, sells shares in one company to a non-arm's length company. Therefore, when you think of it from the family perspective, go back to my daughter example, instead of selling to my daughter, if I'm selling to my daughter's company, and the rules in 84.1 go into a little more detail, refers to being connected after the sale, etc. But the essence of my sale to my daughter's company is that's going to be caught by 84.1. Contrast that to a sale to an unrelated person, recognizing that you can be unrelated but still deal at non-arm's length as a question of fact. Also, 84.1 has some deeming rules. We have a small group of persons controlling companies, so you've got to be wary of that. But generally, if I'm selling to that unrelated person's company, I don't have 84.1. And this next slide then looks at what the result can be if I'm caught by 84.1. I sell to my daughter's company, my proceeds that are in excess of that hard basis. So if I've just started off a company many years ago, my hard basis is probably very small. The difference between the proceeds I received from my daughter's company and my hard basis, that nominal amount, will be a dividend, not a capital gain. Therefore, I can't even use my exemption, and I have a higher taxed amount being a dividend, in many cases an ineligible dividend being taxed in excess of 40%, versus a capital gain which could be covered by the exemption, or any amount that isn't is only taxed at, say, 25%. If I make that same sale to that unrelated company, and assuming we're not caught by the other provisions I just mentioned on the previous slide, I have my capital gain. I can use my exemption. And again, any amount is in excess of the exemption will be taxed as a capital gain, not a dividend. A much better result. It obviously leads to the question, is that fair? Is that appropriate when you're trying to hopefully preserve family businesses within our country, when you can get a better result by selling outside the family? Interesting that Quebec provincially has some limited relief for certain Quebec companies. Obviously that's not federal relief, but you can do certain transactions in Quebec where you're not subject to 84.1 under their rules. No other provinces, and of course federally we don't have any such relief, at least not yet. Therefore, stay tuned. Hopefully we're going to see something in the not too distant future that will reflect some relief in this area, but right now we don't have it. And in the meantime, please don't forget about 84.1. Let's now look at a pipeline. I'm going to do an overview of 3 recent pipeline rulings. Before I get into that, though, just a brief refresher on what do we mean by pipeline. It's usually done in a post-mortem context. Individual owns private company shares dies, has a large gain on death because of the fair market value deemed disposition rules. We'll assume there's no surviving spouse or spousal rollover. And now the estate has this large or increased cost base, recognizing that we still have to be wary of 84.1 even in those contexts to the extent that that individual had used the exemption or someone related to them or not arm's length had, but we'll put that to the aside. We now have a stepped up cost base to the estate. In order to avoid double tax after death, one of the alternatives is to do pipeline planning where the estate transfers those shares to a new co, usually for a promissory note, sometimes for high paid up capital shares, which becomes the pipeline. Eventually, the two companies, the new co and what I'll call opco, merge, amalgamation or a wind up, and now you have one company. Several years ago, CRA raised some concerns with respect to pipeline planning. In particular, they brought up 84 sub 2, and that perhaps you didn't have a pipeline you could repay without any further tax, but perhaps you had a deemed dividend at 84 sub 2. Most, maybe all practitioners are scratching their head as to why that could apply, why 84 sub 2 could apply. But in any event, CRA had raised it and caused a lot of angst. Having said all that, though, over the years they have given a number of favorable rulings, which is obviously a good thing. And I'm going to focus on 3 recent favorable rulings that they have given. This first one was a post-mortem pipeline, and I just want to go over some of the detail within the ruling. It talked about that amalgamation of NewCo and OpCo taking place 12 months after that transfer of shares to NewCo. So some time had to elapse before you did the amalgamation, consistent with most of the rulings that they've given. In the period between setting up the NewCo and doing that amalgamation, dividends were paid from OpCo to NewCo, more or less equal to the after-tax income of OpCo, probably a safe income type calculation, and then dividends were distributed, then paid from NewCo to the trust and distributed out to the beneficiaries of the estate. When I say trust, at that point it was still the estate. The amalgamated company, once that amalgamation did take place, continued to carry on the business of OpCo, again consistent with pretty much all the rulings we've seen in the past. Although in this case, Amalco, the amalgamated company, had to sell some assets to fund the payment of the pipeline, fund the payment of the promissory note. Interesting when you look at the ruling, and this ruling in terms of what the amount of repayment that could take place. In particular, under the proposed transactions for this ruling, they said that the repayment of the note for each quarter of the first year after amalgamation couldn't exceed 15% of the original principal amount of the note, of the pipeline. Therefore, when you do the math, it means after that first year after the amalgamation, 4 quarters, 15% per quarter, at most you can have repaid 60% of the note after that first year of amalgamation. Therefore, when you look at person dying, then at some point doing the amalgamation after setting up the NewCo, you're looking at least 2 years out, you've been able to repay not all the note, but only 60% of it. Again, the number isn't necessarily the same in each ruling, but certainly what's consistent in all the rulings we've seen is that CRA doesn't want you to be able to get everything repaid as soon as possible. They force you in a way through the proposed transactions and presumably through discussions with them just how long it can take to repay the note. If I can look at the second ruling, again a post-mortem pipeline. Many parts of this ruling have been redacted. It's not clear in terms of all of the timing, but certainly what it talked about is after amalgamation, again NewCo and OpCo being amalgamated, the amalgamated company was going to continue to carry on the business, again a consistent theme with these rulings. But also interesting to note, after the first year, or for the first year I should say, after amalgamation, how much could you repay the note? Well, in this set of proposed transactions, the amount that could be repaid on a note could not exceed 10% of the original purchase price. So a much lower amount for that first year after amalgamation, 10% versus the previous ruling of 60%. But again, both rulings were favorable, which obviously is a very good thing. Third ruling, this one is not post-mortem. It's an interesting one. It's in French and involves an inter vivos trust that is subject to the 21-year rule. Therefore, for whatever reasons, perhaps the terms of the trust, perhaps family decisions, they decide to get hit by the 21-year rule. A large deemed disposition within the trust of private company shares, large gain having to be realized by the trust. But what they're asking for in their ruling request, and again, it was another favorable ruling, is that they would then do pipeline planning. They've got a stepped up cost base within the trust because of the 21-year rule. They're now going to transfer those shares to a new co and use that higher cost base to create pipeline. Not sure how often any of you will have to run into this kind of situation, but if you are going to have to be stuck with the 21-year rule applying, you've got private company shares, large gain, look at this ruling. It may be something that can at least mitigate future distributions and mitigate double tax by using pipeline planning. One last thought regarding pipeline, and this references 212.1, which is essentially the 84.1 equivalent for non-residents. There was some legislation that was introduced in the 2018 budget that expanded the web of, or the cast of 212.1. There was a couple of versions of draft legislation, the most recent coming out in October of 2018, and what they've done in that legislation is expand or provide for a look-through rule to partnerships and trusts to essentially deem, in many cases, a non-resident beneficiary, in the case of a trust, to be part of the transaction. When you think of it in the context of post-mortem pipeline, what these rules could result in is the non-resident now being deemed to have, on a look-through basis because of 212.1 possibly applying, having received a dividend, subject to withholding tax, etc., and in the worst-case scenario, perhaps being deemed to have disposed of all of the shares, being subject to a deemed dividend on the entire amount of pipeline, even though they may be one of several beneficiaries only receiving a portion of the estate. I'm not going to delve into this issue any further, but will refer you to 3 recent articles, one from the Canadian Tax Foundation Focus publication, another from Canadian Tax Foundation Tax Highlights publication, and the third from a recent KLU Info exchange, which gets into this analysis in much more detail than I have and can show you the potential problem. Maybe it's inadvertent, maybe we're going to get some subsequent legislative relief, but please read those articles if you have this kind of scenario. One of the other issues that's come about with the October 2018 version of the legislation is that it's effectively retroactive to the first version of the legislation, which happened earlier in 2018. In other words, someone could have done a transaction which didn't appear to be caught between that first version in October 2018, which may now be caught, which, if nothing else, seems entirely unfair. But please read those articles if you have a situation that may be very similar to a non-resident beneficiary and doing pipeline planning. So that concludes our webcast. On behalf of Maureen and Robert, I'd like to thank all of you for taking your time to listen in. As Maureen and Robert have mentioned, this has been a new way for us to provide the webcast to you, a new distribution format, and we welcome any and all of your feedback. If you do have any comments, some things you'd like to see done better or differently, please use that email address shown on this slide, webcast@step.ca, and we'll receive that email and look at them accordingly. Thank you, Maureen. Thank you, Robert. And with that, we will sign off.